live from the city. This is the High Valuation Code with Matteo Turi.
Good afternoon, everyone, and welcome to episode 2 of the High Valuation Code Live. And if you remember last week, we explored why profitable businesses still fail. So we discussed structural fragility, the weaknesses that do not appear in revenue or EBITDA. But today we are going to go deeper because collapse is not the first signal that you are going to see. Is rejection is, capital hesitation is, and investor doubt is. And doubt appears long before failure. So today we ask, why does capital say no, even when your numbers look strong? And more importantly, how can we diagnose that before we walk into the room? So, Matteo, welcome to the live streaming. Over to you. So, the big question: how we can diagnose that before we walk into the room?
Now, thank you so much, Francisco. I've been trying to answer this question for 30 years. Why does capital say no? So yeah, there's been a lot of experience about this. Okay, let me say this clearly. Now, capital decisions, that comes from either investor or banks. They are really about numbers. That's what I learned. People say, oh, it's all about the numbers. Yeah, no, it's not really. The capital decision, they're really about structure. How your business is actually analyzed, how it passes, we call it the filter, which you're going to go into a few moments there. Because let's face it, two companies can show identical revenues and margins. Guess what? One gets funded, the other one doesn't get funded. One pays a 3 times revenue in terms of valuation, in terms of EBITDA, for example, 3 times EBITDA. The other one will try a 9. So 3 times difference in valuation. Same numbers, by the way, same EBITDA, same margin. Now the difference is not really effort, because that's not what investors care about. The investors, they care about architecture, they care about the structure. And over the next 12 weeks, I'm really so glad that we're going to build architecture really step by step. And this is one of the most important building block we are building today. So today really is pillar 1, which is fundability. Now, if that is weak, why are we starting with fundability? Because if fundability is weak, everything else will collapse. So that's the reason why we're doing it today. Thank you, Francisco.
Excellent. Oh, no, you're very welcome. And just to give context, then why we're doing this is a process, by the way. So actually, we are going to break it down because it's as an architecture process, you need different portions to build this fundable business. So here's what the journey looks like for the next few weeks. So we went last week with why profitable businesses still fail. And this week is this week we are profitable business still fail. Next week, we are going to talk about why capital says no. And the following week, 3 and 4, how to close the fundability gap. And in week 6 or 7, just reaching end of March and beginning of April, governance and structural risk treatment, and then capital engineer and control scale. And finally, close to end of April, we're going to go into valuation, capture, and exit design. So this series is cumulative. So you're going to have a very good journey from the beginning to the end, how this works. And if you miss the foundations, later prices won't hold if you're looking into improve the fundability of your business and what is the architecture involved in it.
Okay, no, thank you so much. Thank you, Francisco. Yeah, it's going to be quite a journey. And the reason why we started with fundability gap is because it's so, it's like, the foundation of a business. Yeah. Well, let's say that there are 2 big things a business must really have in order to have, a good recipe for success. One is positioning and 2 is structure. Okay.
Right.
Now, this is really, for many, this will come as an uncomfortable truth, Even most CFO, my peers, people who've been in finance, they believe always that they're ready for capital because they
Right.
obviously look inside the business and say, well, this the numbers stack up really well, so I'm sure this is going to work very well.
Yeah.
So, and most founders on their end, they believe that growth will fix structural weakness. Yeah, they think like growth is absolutely everything.
Right.
Unfortunately, growth will not fix structural weaknesses because, in actual fact, I always say this: growth without structure can actually, basically, I will translate into velocity towards risk. Yeah,
Right.
the faster you grow without structure, the more you are running towards a risky situation, potential
Yeah.
failure as well, even if you're growing.
Yeah.
Now, growth in general amplifies the architecture of a business. I'm using the word architecture because it's really something you engineer. It's not something you just improvise, yeah? If the
Yeah.
structure is strong, the growth increases valuation. And valuation, let's not forget, valuation always depends on risk. You know, the lower the risk, the higher the valuation. If the
Right.
structure is weak, growth will accelerate fragility.
Right.
So that's what I say. Growth without structure can actually be the worst thing you can actually do with your business.
Right. Right. Yeah.
Let's face it, capital does not invest in just revenue, yeah? Because, you know, revenue is okay, you have a business, but what about having an enterprise, you know?
Yeah.
Capital invest in clarity. Um, Clarity is really fundamental, and clarity is really engineered really before the fundraising begins, not after. So
Yeah.
you can't wake up one morning and say, "Well, I need to raise funds. I need to show that I have a structure. I need to show that everything is clear about my business." You organize that well before. So that's the
Yeah.
key. That's the key uncomfortable truth for many.
Yeah, and I think that is I think you hit it right on the head there because the clarity is engineered before fundraising begins and this is a misdiagnosis trap, I guess, because um, they say capital says no, say we went for fundraising and they come back with a no all the time. So and then companies often respond by adapting to that no, improving pitch decks, raising growth forecasts, hiring advisors, tweaking valuation expectations. But investors are asking different questions. So it's not just about a better, well-crafted graphic designer deck with a better roadmap. It's what are the silent questions that they're asking that is more interesting to understand today when the company needs this infrastructure or architecture to raise capital.
Yeah, you mentioned the heart of the problem, which is the reactivity. Yeah.
Right,
So
reactivity. Yeah.
when somebody say, okay, well, somebody realized that something is not working, say, well, let's react. Let's improve the
Yeah.
pitch deck. Let's maybe, you know, put numbers in a different way. Let's raise the growth
Right.
forecast so people will say that we are solid. Or maybe let's react. Let's talk to some advisor. Maybe they give us some answer and
Yeah.
etc. You know, in fact, you know what they're missing is the fact that every investor actually applies five structural filters. You know, you need to be aware
Right.
of these five structural filters. They will not say them explicitly. They're not going to tell you, okay, I'm going to apply this five filter to your
Right.
business, but they always apply them. And I will start with the first one. You know, the first filter
Yes,
they
please.
apply, which is transferability. Um, this is where the investor and the bank as well, they will start studying your business. They will start to say, well, if the founder disappears, does revenue survive?
Right.
Now, this is actually even more accelerated as an issue today because we live in extraordinary times. You know, we've seen this. We saw the news, the forecast. Well, we got AI-driven economies
Yeah.
that are really with us right now. So, and also we can see a very I would say an unprecedented rise in private capital markets, There are an additional $10 trillion coming to
Wow.
market in the next 48 months.
Wow.
This money is not looking for business where, they don't have really visibility about what's going to happen to a founder-centric business. Well,
Right, right.
first of all, artificial intelligence will make founder-centric businesses even weaker because effectively, if everything is in your head, nothing is documented,
Yeah,
AI is got nothing to scale. So
yeah,
investor, they're gonna start really ask you this question about how documented are your processes, yeah? And if they are not sure about the founder, immediately capital hesitates. And that's something I always say. Capital always backs financial intelligence, Without
yeah,
financial intelligence, capital will not come to you. Now, funder dependency is invisible on a profit and loss account. You're not going to see this on a financial statement.
right.
But unfortunately, when it comes to due diligence, all this becomes really obvious. Again, this is, I think, the first big filter that
Yeah,
you will find when you meet an investor, you meet a bank as well.
yeah. No, and I think actually that is very true transferability. And actually something actually I've seen quite often when you look at it, this is our team. And pretty much is the CEO and the chairman of the board, even if they have a board, some companies don't even have a board, like a formal board, is the same person. So the question is coming into diversity, not diversity in terms of gender or religion, diversity in cognitive perception of how is the business perceived, because if a founder is the head of everything and everything cascade down, that governance maturity seems to be missing, because actually how that is going to operate without this person if they retire, or they take a chunk of the if they go public and they take their shares and they go onto the side, who is going to drive the business as they should be? So that decision making, the pricing authority, but most of the time is a relationship concentration. So where this person is concentrated all his network that actually build that business and continue that or going deeper into that network to expand the business, to grow it. So in short, the organization becomes very fragile. So even if revenue is diversified on paper, which is always something we look into that, but investors look at for institutional processes, not necessarily personality-driven growth. Is that right, isn't it?
Yeah, no, thank you so much. And Francisco, because obviously you're an expert also in governance, that gives a very qualified opinion about what we're talking about. Because yeah,
Mm,
governance, people say, okay, well, let's fix governance later. Well, that
yeah,
never happens. We know that, in your
yeah,
experience, because of your experience as in board of directors. Now,
yeah,
governance will add significant weight to your proposal to investor and banks. No
yeah,
question about that.
yeah,
Investor will be absolutely able to uplift their own the valuation of the business because leadership depth really creates higher valuation. Creates what I call is the biggest really lever for valuation from investor.
right,
The word is confidence, which is backed
yeah,
by optionality. We always talk
yeah.
about this, yeah.
Yeah, you mentioned
Um,
5 filters. Sorry to interrupt you. So you mentioned 5 filters. What would be filter two in this case?
Yeah, let's come to filter two now. We've spoken about
Yeah,
founder dependence. I call
yeah,
it founder detox, dependency
right.
detox.
Good
Just to make
term.
it a little bit fun. Because in fact, that's what will cause a business to fly. When you remove
Right,
that dependency. Now, the filter two is revenue durability.
right.
Now, you can show historical statements
Yeah,
about what the business did, how much revenue it did, how much is it forecasted to do effectively. But
yeah,
investors really don't care just about growth first. When
right,
it comes to revenue, they care about survivability. Okay,
right.
now this is something that is fundamental. We're talking about the quality of the revenue. Now, is the
Yeah,
quality of the revenue high or is the quality of the revenue low? And they
right.
examine certain things. For example, the contract length. Yeah, how long is this contract with this customer going? How valuable is what you do for the customer effectively?
Yeah.
So again, this is not something you're going to see just on numbers. You need to go deeper in due diligence. You're going to look into documentation about contracts, how you generated those revenues, and how you're going to continue to generate, which is even more important. The other thing that is very important is recurring revenue percentage. Now, the more
Right.
recurring the revenue, the better, because it's part of a very scientific calculation. It's the lifetime value versus customer acquisition cost. The higher
Right.
the
Right.
lifetime value is compared to the customer acquisition cost, the better the quality of the revenue.
Mm.
The other thing is obviously customer concentration. Now, if your revenues are dominated by just a handful of customers, that becomes a real big risk factor the
Yeah.
investor will start to look into. And let's face it, this is where the smaller the business, the faster it breaks,
Right.
unfortunately.
Yeah.
This is why bringing financial intelligence later rather than sooner may cost you absolutely everything. So
Right.
make sure you are on top of this. The other thing is the
Yeah.
margin stability. And again, this is where unfortunately there's another uncomfortable truth here. We see so many businesses, they're growing the revenue, they're growing the top line, but they do this at the expense of margin. Now,
Yeah.
you don't want to be in a position where you are growing the revenue, but you lose the discipline about keeping the margin high. Because guess what's happened when you decrease the margin? You start to have some cash flow leakage from margin, then some more cash flow leakage on discounts given to customer, some more cash leakage for credit terms, some more cash leakage because of suppliers. Well, the investors start to see that there's too much risk here, even if you're growing, yeah?
Yeah. Yeah.
So as a rule of thumb, I would say this: if revenue must be won again every year, valuation compresses. Make a big
Yeah.
difference between new business and account management. Make sure that your account management is working really well.
Yeah.
And growth without durability is volatility. And investor and banks, they just hate volatility.
Yeah. Oh no, yeah, yeah. It's not the predictability in this business model where you have to, as you mentioned, win again every year. The business to maintain those ratios is quite challenging to invest into. I'm curious about number three. What would be the filter number three for this?
Okay, yeah, number three. Let's talk about something that is very widespread in so many small businesses. It's called
Yeah.
capital stack clarity.
Right.
Now, what is capital stack clarity? This is where many finance teams really underestimate the issue. And capital stack is a major problem in so many small businesses that they have no financial intelligence inside the business. Well, they think that the bookkeeper is going to fix everything. Well, that could not be further from the truth, unfortunately, because the bookkeeper will tell you the past. The investor, they just want to
Yeah.
know how you're going to manage the future. So,
Right.
so the big question that I will need to ask finance professional is, have you modeled a downside scenarios? Yeah. For example, what if something breaks? What if, the market changes? Again, this is where you need to
Yeah.
look at the external market. Always keep abreast of interest rate market. Always keep abreast about on capital markets in general.
Right.
See how those play because they are not indifferent to a selection from investor. Yeah. So
Right.
downside
Right.
scenario, fundamental. So this is where finance team they really need to be able to forecast what happens in more than one scenario. You usually tend to have three
Right.
scenarios. One is the base case scenario. The other one is the best case scenario. The other one is the worst case scenario.
Right.
The other modeling requirement is about working capital stress. Now, I've seen already this year two businesses failing incredibly because of working capital. They were growing really fast, but they could not manage the funding gap. The funding gap
Right.
between the working capital needed and the profitability of the business. If your profits is say 10 million, but you got a funding gap of 30 million, your growth will actually kill your business.
Right.
So working capital is fundamental, and it's about really inventory. It's about receivable customer. It's about suppliers. Yeah. Now, the other modeling skill that is required in this capital stack situation is debt service under pressure. Now, can you service your debt under pressure if
Right.
situation changes? Yeah. Because the
Yeah.
investor will ask you, okay, well, you're telling me you're doing, or the bank as well, they'll tell you, okay, you're now able to have a good ratio. Let's say for every $3 of cash flow generation, $1 is needed to service the debt. But what
Yeah.
happens if situation changes? What happens if
Yeah.
those $3 they become $1.50? Are you going to
Yeah.
manage the situation after that? um,
Yeah.
the other thing is dilution impact. What happens if you actually have convertible loan notes? If you go interest, they are actually due or to an investor for a particular covenant that you've done in the
Yeah.
past. So dilution impact, is fundamental as well. Now, the other thing is exit waterfall logic, yeah? So
Right.
investor needs to understand really what happens with the capital once you do round one, round two, right, round three. You need to engineer
Yeah.
this before you start raising capital, not after. Because if you are saying to an investor, well, I'm gonna offer 20% equity, but then I need to do another round where I'm gonna offer another 30% to someone else, clearly, that decision about what you're going to do later is going to impact the decision of the investor now. So, capital, there's one very strong statement I have to say. Capital does not like improvisation. Capital
Right.
likes
Right.
structuring. Capital likes pre-organization, and
Yeah.
if the structure feels reactive, confidence really drops. I wonder
Yeah.
if you want to know
And
about filter phone now.
yeah, no, yeah, but it's true because actually I've been racing for a biotech that is how it's called, a spin out from a very well known university in the UK. And in terms of the technology, they are brilliant. They have something that actually have been thoroughly researched. Then they spin out. Now they are building the business, but unfortunately, they don't have this architecture of what's going to happen next with when the rounds of capital. So they had a pre-seed. They have a seed now, and unfortunately, because exactly what you mentioned, there is no foreseeing what is going to happen with the next round, how it's going to structure this. The investor all of a sudden this it's not that they disappear, they are on hold, everybody thinking what is going to happen next, and they are pretty much stuck in the investigation and the data collection to prove the concept and just go to the first the minimum viable product, because exactly this it's not about the idea, it's not about the science, it's about the lack of a structure of how the next steps are going to happen in terms of dilution or no dilution of the company. Yeah, I think it's brilliant what you're saying, because actually it's not seen, probably the way that the structure is like, oh, we are going to do rounds and we are going to be fine, instead of thinking thoroughly what is the process that is happening the other side.
Yeah, this happens a lot because finance always comes too late to the game. Yeah,
Yeah, yeah,
it feels reactive to say yes. It feels good to say yes. I want that capital, but then if the terms and conditions are not the correct one, or they're not really something that you want to present to the next investor,
yeah,
then you may feel you're in a cage. Actually, many times I see this happening. I can see this happening with angel investors as well. They
right,
they, they start they start really investing a bit early stage. They start to really negotiate something, but they can see
yeah,
mostly that the founder doesn't know doesn't know the consequences about what they're negotiating. And that it may me feel good to actually receive capital, but once you are in that situation where you go obligation, then
Right.
you might feel like you're saying, I wish I didn't do this, or I wish I really brought financial intelligence into the business earlier,
Yeah.
which unfortunately, yeah, this is so systematic. Unfortunately, this is where founder thinks that either they feel intimidated by finance,
Yeah.
they feel, oh, well, if finance comes, they're going to control everything, or they feel, oh, I cannot afford it. But
Yeah.
guess what? The cost you're going to pay by not having financial intelligence is going to be really huge, and you're going to
Yeah.
regret it later. That's unfortunately what
Yeah.
happens all the time. Yeah.
Usually you see these horror stories in LinkedIn. They say, "Oh, I've been an angel investor, and actually, when in second round, I so diluted that now I lost money." And actually, because also I think it's a lack of education on both sides sometimes. Actually, not only from the founders and what is the architecture they put in finance, also from the people that are investing. Sometimes it's like I don't know, a expensive hobby instead of being a real investment because they don't know, they cannot see also what's happened next.
And in fact,
Um,
capital stack requirement is going to be a topic we're gonna have, I think, on week 8. Yeah. So we're gonna
yeah,
talk so
yes,
much
yeah,
more
it's
about
coming.
capital stack. But capital stack requirement is probably one of biggest uh, the biggest fault we see
Right.
early stage business. They never think
Yeah.
about it. They never do, and they
Yeah.
always think, okay, let me get the money now. It's just
Yeah.
it breaks many
Yes.
businesses, unfortunately. Yeah.
Yeah. Unfortunately, yeah. So what about filter number 4 in this process?
Okay, let me come to the full filter, the investor and
Yeah.
bankers. This one is about the visibility of risk and the treatment of risk. Yeah.
Right.
Now, don't
Okay.
forget something. They always say, while you are selling your upside,
Yeah.
investors and the banks, they are measuring the downside risk. Yeah.
Mhm.
So this is why when you talk to an investor and to a bank, be aware about the real mindset. The mindset is they're listening to you. They're saying, yes, I love it, but from the really back of the mind, they're really calculating how much risk there is there.
Yeah.
Now, so if you're raising capital, banks or investor, and the risk is undocumented, yeah,
Right.
investors will assume there's an exposure. And uh,
Right.
and when investors assume there's an exposure, you are suddenly immediately weak in your negotiation position.
Yeah.
So this is a filter you just don't wanna supersede. You want to make sure you are on top of it. Yeah, you
Yeah.
know what risk is. You know how to calculate and how to manage risk.
Yeah.
Now, what do they want to see? The investors and the
Hmm.
banks.
Right.
Well, they want to see, first of all, I would say 5 things. First of all, a defined risk appetite. Yeah. So
Right.
they want to make sure that you understand risk. They want to make sure that you're able to answer the question, what if something breaks? What's
Right.
going to happen? Have you calculated? Because let's not forget, investors, they will not want to see you, in a in an exercise to say, well, I'm perfect. This is a perfect scenario. There's perfection does not
Yeah.
exist. I would say perfectionism is an illusion. It's a very expensive
Yeah.
illusion. By investor, they will expect you to manage the risk.
Right.
First, you
Yes.
calculate it, yeah. The second thing is a prioritization logic, yeah? So there must be a ranking for all the risk. There must
Right.
be a probability calculation somewhere that tells you, look, if this risk really hit us, then we need to really be on top of it. Now, risk is not about pessimism, okay? Because risk is about, I talk about risk asymmetry, yeah? Now, risk asymmetry is where you are carefully really calculating the downside, but you're also engineering the upside, yeah?
Right.
So
Right.
prioritization logic is part of this as well. Now, the other thing about risk, the third one is clear ownership. There has to be ownership of risk in the risk register. You don't want to say, oh, I decided that I have a risk, but no one is taking care of it. You have to really make sure that each item on the risk register is owned by somebody.
Yeah.
The fourth one is residual risk measurement. Yeah. Now there are emerging risk, there are big risk, and there are also residual risk. You
Yeah.
need to be able, you can measure those as well, because if you don't, you will be hit by an unexpected risk there again as well. And the last one is monitoring system. Yeah.
Yeah.
Now, risks are always there. Whenever a business exists, risk will exist. There's no question
Right.
about it.
Yeah.
There are gonna be trade-off decision, countless trade-off decision, and don't ask
Right.
ChatGPT to help you with that because uh,
Yeah.
you have to really manage the risk every day. So
Yeah.
every time you make a decision, there is a risk. If
Yeah.
there's no risk, it means you're not running a business. That's
Yeah.
that's simple. So you need to have a monitoring system. You need to have it very frequent. You maybe want to, I mean, there were some situations in my career where my risk register was updated weekly because I was working in a fast moving legislation environment, renewable energy. You
Right.
couldn't do it less frequently than a week.
Yeah.
Now, it's not a spreadsheet, yeah? It's a system. So you need a
Yeah.
risk management system where you are really showing an investor that you own that. Now,
Yeah.
this system will pay you big when you speak to investor and banks. When you talk about risk to them, they will put you up there. Obviously, they will
Yeah.
expect you to have financial intelligence in the business because
Yeah.
without financial intelligence, unfortunately, you are missing the prerequisite to convince an investor or a bank.
Yeah. Yeah. No, actually, I love what you mentioned, the residual risk measurement. And this is a case that actually we were working last year with a company in terms of compliance. So we have all these frameworks in terms of the obligations for the company. And one of the things actually, we are going to map out all our risks. And but in the frameworks of the compliance frameworks, there also is a big list. I say, but actually, a paragraph in one of the compliance requirements was why you are not addressing this as a risk. So not only you have to justify how you're going to handle or manage or who is the owner of the risk itself, also if you decide not to address one of the risks listed or based on materiality analysis in terms of your supply chain could be upwards or downwards, why that is not a risk and why you decided that is not a risk, and eventually who will be the trigger that will move that into a risk that have to be managed. So I love that you mentioned this because actually you often don't see that kind of thoroughly mechanisms or systems into the organizations when they're managing risk. I love this one.
And once again,
Uh,
with your experience in both governance, you know how risk management is so important, yeah?
it's key. Yeah, yeah,
Controls and risk management. So yeah, your experience on that is absolutely priceless, yeah.
yeah. And the last one, but not least one, the fifth filter.
Yeah, we said we promised five, so we have to deliver
Yeah,
five. So,
right. Yeah,
so this is
the
the
last
fifth
one.
one. Actually, well, the fifth one is exit optionality. Now,
All
that
right. Yeah,
that word optionality is so important. It's the opposite of dependency. Whenever you speak to an investor, try and make sure that the word optionality is there everywhere. The word
yeah,
dependency is nowhere. Okay, so that's
right.
one rule I would say.
Yeah,
Now, there's a question capital will always ask. The question is, how do I get paid?
right.
Okay. So don't expect the investor or the banks just to sort of fund you because you need the money. They need to know how they're going to make money out of the money they're going to pay you
Yeah,
effectively.
right,
Uh, so the big question is there a credible pathway for the exit effectively? Yeah.
right.
So it has to be credible, of course. Yeah. Now I
Yeah,
would tend to see most frequently four type of credible exit pathway. The first one would be a trade sale. Okay, so let's say if your business is credibly uh, you know is credibly, business that can be offered for a trade sale in future, that can be
Yeah,
sold to someone else, yeah? Not necessarily
yeah,
on capital markets, but there is a
right,
potential buyer for the business, or there could be a number of
right.
potential buyer. So trade sale is quite straightforward, yeah. The other thing
Yeah,
you could actually do, and again, with financial intelligence, you can do this very well, is recapitalization. Okay.
right,
Now, you could actually be quite creative with creating an exit option for the investor through possible recapitalization in future. Now, what
right.
happens is, I mean, here, if I talk about recapitalization, I would need to really spend hours and hours because there are so many ways you can do that.
Oof, yeah,
But it's effectively when you know you're gonna need more capital in future, and so the investor will exit better terms than when they entered. Yeah.
yeah,
The other one is strategic acquisition, and this is where M&A could come into play. If the business sits in a sector in which acquisitions are likely, obviously there's a discussion to be had with investor. Yeah,
yeah,
M&A, as I said, can work in both direction.
yeah,
Both when you need to expand your business and you build the right balance sheet. Yeah, because don't forget, you don't just buy a business because you want to buy a business. You must have the
right,
right structure, the financial structure as well. The other way, it could be a dividend model. Let's say you can offer a special dividend or a structure around dividend that will allow the buyer of the business to, or actually, yeah, the investor in this case, the business, because they are
right,
investing into your business right now, getting as much capital as possible back. Because let's face it, if you, let's say, give it a numerical number, if you have a business that needs $1 million capital and you expect to make a profit of, let's say, 10 million, let's say,
right.
in year 5, you may
Yeah,
actually offer the investor, well, you're going to get 3 million out of the 10
yeah,
million, for example. And that can work better for the investor because okay, not only we can get all of our money back and more, but we will also continue to be shareholder in the business. So again, this
right,
is another way to give exit optionality.
right.
One, one thing I would say, if the exit logic is unclear, hesitation increases. I would say this as well. Even if you're never going to exit, and you're never gonna need an investor as well, an exit plan
Right.
is fundamental in any case when you really want to be ahead of the competition because exit plan, well, first of all, they give you the optionality. What if someone comes with an offer I can sell?
Yeah.
But secondly, when you have an exit plan that you're working towards, you are already effectively ticking all the boxes needed
Yeah.
to be ahead of the competition. You're ticking all the boxes to have better customer relationship. You're ticking all the boxes to have better bank relationship. And just in case someone comes and they want to buy your
Yeah.
business, you're not going to be in a bad position either. So again, when many founders think, oh, there's a cost associated to creating a leadership team, well, the hidden cost of not doing that is much bigger than the cost you're thinking you need to
Yeah.
incur. So I would really widen this discussion, and we'll talk about this in the next few weeks. In any
Yeah.
case, so I would
But
say,
I think it's sorry to interrupt you, but I think that is a very good optionality, exit optionality, because sometimes it's not the obvious one, but is hidden in retirement. So how you transfer your business to the next generation, or if you want to retire, how this business is going to continue, because at the end you need to prepare everything to that point. And we've seen that these kind of things take time. It's not something, as you well said and explained so far. It's like it's a process. It's a system that you have to create, and that doesn't happen in a couple of quarters. You need like 2 or 3 years to build all this correctly. But and if you have the advantage or the grace to start this when you are a young founder towards the next 20, 25 years, even better, because actually it's a traceability and a linearity of what you're doing, how you've done it. So in terms of procurement, governance, it's all these things that you mentioned, the five fillers here that, or the five requirements for investability or acquisition or retirement, because you can transfer these with confidence that it's not going to collapse next month.
Yeah, this is where I have to say, this is where even 2 weeks ago I spoke to another founder. They're doing a very good business. That they're very profitable.
Yeah,
They've been approached by somebody about really buying the business, part of the business. Then they walked away for a while. That they don't know if they're gonna come back.
right.
And I told them, well, if you want to build a valuation for the future so that you know you have the highest possible result,
Yeah,
you have to really you have to engineer valuation day after day after day. When the
right.
investor comes to you and ask you what's your valuation, the valuation is not because you just pick up the phone, you speak to an advisor, you tell them, can you calculate my valuation? That's not really the valuation. The reason why
Right,
this series is called the High Valuation Code is because we are looking for a high valuation strategy.
right.
And the valuation is something, is a result of thousands of decisions you make
Yeah,
every day. And you need financial intelligence for that. Yeah,
yeah,
that's something that I strongly suggest. Why do you need financial intelligence for that? Well, investors will always back financial intelligence, first of all.
yeah,
And secondly, well, let's look at what happens in the world. When you
yeah,
see a failure of a business, does it never happen because of lack of financial intelligence? That's the answer is financial intelligence is always at the center of failure, unfortunately.
right.
So not only it's about founder, it's about us, finance professional. We have to stand up. We need to go beyond our job description. We need to go out and say, well, look, not only we are doing a job here, but we are actually helping the business to yeah to be a healthy business, to be a profitable, to be a successful
Yeah,
business. So
yeah,
my end on these five filters. Let's go about
yeah,
my conclusion on these five filters.
yes,
Um, yeah, if you cannot answer those five filters clearly in 2 minutes, yeah,
right.
capital hesitation become natural, and you're gonna lose score on
Yeah,
valuation. The investor, they're gonna start to raise the risk factor. They're gonna
mm,
lower the valuation. They may walk away, which is actually quite normal.
yeah,
And so those five filters are really fundamental. So you need to be able to answer those if you
yeah,
want to be fundable, okay? I thought, Francisco, we should probably introduce a concept here, is the fundability gap,
all right,
which is the distance between performance and investability.
all right.
Because most companies, they really optimize performance, but very few optimize on structure. Tell me what you think, yeah?
Yeah, well, actually, it's very true, because it's a kind of obsession. So we are lean, we are clean, we are doing this, we are doing the other. But unfortunately, many of these companies are, they think that actually a clean operation or a fast operation or efficient operation means we are investable. So we can go into different sources and present a deck and say, this is what we do. So we are looking for funding for growth, for working capital, you mentioned, et cetera, et cetera. But that's very interesting that you mentioned that between performance and investability is a gap there. And it'll be interesting to understand how you look into that based on your experience and all these years working with companies.
Yeah, so basically, yeah, we got two things, performance and investability,
Yeah,
okay? And I tend to also break that gap into three layers, okay? Do you want me to tell you about the
right.
layer one?
Yes, please. Yes.
I'll go ahead with layer one, yeah. The layer one is from one end you go performance, from the other end you go resilience, okay?
All right.
Now, the concept of resilience is very important for to be fundable, to be investable. Now, performance is revenue and EBITDA, okay?
Right.
So you just have a few numbers there, two numbers in this case, revenue and EBITDA. So they're easy to find because they are you just extract the financial reports and you're gonna find out what those numbers are.
Yeah.
What's resilience? Now, resilience is something different. Resilience is cash timing, governance maturity,
Right.
risk clarity, and capital durability. Now, these are really important for the investor because the investor they fund resilience. Performance is secondary. So you might show very well, you might show whatever performance you have in terms of revenue, in terms of EBITDA, but you need to also show how good you are at timing the cash, okay? When do
Right.
you get paid from customer? How do you pay supplier? How do you manage your inventory if you got inventory, okay?
Yeah.
So that will give resilience to the business. Resilience, which means
Yeah.
those revenue and that EBITDA will generate cash flow because you organize your business very well with cash timing.
Yeah.
Why governance maturity? Governance maturity is because investor and banks will know very well that if you do not have a good structure behind the founder, for example, you will be likely experiencing execution gaps.
Yeah.
Now, execution gaps usually comes from, I call it emotional situation,
Hmm.
emotional exposure, like attachment, avoidance, and for example, yeah, even fear. Say, say for example, you've managed a business and you committed to spend money on a specific project, yeah.
Yeah.
After 1 year, you realize it's not going well. What do
Yeah.
you do rationally? Well, unfortunately, many people they will say, "I'll continue because I committed a budget. I'm not going to stop
Yeah.
it." Well, unfortunately, that's a big problem because you need to stop when it's time to stop. Yeah. If the
Yeah.
project is not giving the returns that it's supposed to give, that doesn't work. So you need to make a decision there. Now, the other thing about resilience is about risk clarity. So make sure you continue on the risk calculation, risk
Yeah.
management activity, because that will allow you to always have what I always called before risk asymmetry.
Right.
What does that mean? You're looking at the downside always, but you're always looking at the upside. It's not about being pessimistic, yeah, because many people think, oh, I'm so tired of hearing about risk. It's about risk clarity. It's not about
Right.
risk exaggeration, really.
Yeah. Yeah.
And capital durability. So capital durability means what about working capital? What about my cash forecast? Do I have enough cash
Yeah.
to enough cash flow generation to service the inventory? What if I need to increase the inventory? What if I need
Yeah.
to maybe do a special deal with a special customer? Can I afford to do
Right.
that? So that's what I say. Resilience is fundamental, and investors will always fund resilience before performance. Performance is secondary.
Right. No, I think actually break it down resilience into exactly because it's a lot of conversation about resilience, but actually nobody really break it down exactly what it means in terms of a fundability to fund the business. And I think that the cash timing, governance maturity, risk clarity, and the capital durability is a perfect breakdown exactly what resilient means for when you're looking for funding or investors or recapitalization. You mentioned recapitalization or refinancing the company. Showing these four legs, I think is practically very clear for investor or an institution to say, yeah, you know what you're doing. Excellent. What will be layer two? Because you mentioned three, and now I'm
Yeah,
very curious to
I
know the
said
next
three,
two.
so I owed you some more. Okay, so basically, layer two is forecast versus
Yeah.
stress test. Stress test is something to say, oh my God, I'm already feel
Right. Right.
stressful. Well, what we can see is that most forecasts are linear, yeah? So they're actually almost like reverse
Right.
engineered
Right.
from optimism. Someone feel optimistic and say, okay, this is what I'm gonna
Yeah.
do. Well, few forecasts are
I
really
love how you
stressed.
put it through because actually that sometimes it looks like
Right. So it looks like everything is going well. Okay. Well, you need
so.
stress test, because few are stress tested.
Yeah.
Now, the big question is, what happens, for example, if receivables extend 20 days? I've been in businesses where we had to really fix that because
Right.
the business was actually going to into a really crisis mode. And we have to really fix that. We have to call the
Right.
customer and say, well, we need to do a plan now. Now, what if churn doubles? What if
Yeah.
the customer churn rate doubles from 6%, it goes to 12%?
Right.
You need to tell the investor what is going to happen with
Yeah.
that. What happened if
Yeah.
input cost spike? And many people they've been through last year. Obviously, this is something that we live every day now. The tariffs from Donald Trump.
Yeah.
What
All
if
right. Yeah.
input cost spike? That's you need to
Yeah.
stress test on that. And I think nowadays even more because of you may have geopolitical situation as well that need to be
Yes.
taken care of. What if growth accelerate 50%? So some people say, well, that's only good news. No, it's not, because if you
It
accelerate
could be a
growth
big
by 50,
challenge.
if you accelerate growth by 50%, what are the consequences, on your
Yeah.
business? Are you
Yeah.
gonna have
100%.
enough support for your customer after sales? Are you gonna react quickly? Are you gonna keep your margins the way they were? Are you gonna acquire market share? Are you gonna lose market share? These are really big questions you need to answer.
Yeah.
I always say stress testing is not pessimism.
Right.
It's about really maturity. So if you
Yeah.
show an investor that you are testing the stress, you are really showing maturity. And maturity
Right.
is a big plus when you speak to banks, when you speak
Yeah.
to investors. Yeah.
Yeah. No, I love it because actually, particularly, I love because you have a very, very organized ways to see the spectrum from negative to positive. And this is not being seen very often when you talk to a CFO, because pretty much their function is actually, yeah, we are right, we are wrong, and pretty much they don't provide a full spectrum of what are the possibilities. And one thing that you mentioned now that I really love is the growth acceleration. And I think that the perfect example was in during the pandemic when all the e-commerce exploded. And who was prepared for that? Yeah, pandemic was a pessimistic situation, a negative circumstance. But the e-commerce literally exploded with the 300, 400% increases. So it was out of the book, the mark or the stadium all the way. And many companies struggle with that in a negative way, because in a negative way, meaning that they couldn't hire fast enough. They didn't have the supply chain prepared enough. They didn't have the infrastructure to organize themselves to deliver the demand of the people. So the people were pretty much waiting for something to be delivered. It could be services or products, either way. Um, because I remember that actually one of the things of the downtowns of this was the overexcitement. We are going 300% in terms of growth, hiring. And when the pandemic opened, so there was no more, how it's called, I quite don't remember. When people could go out again and there were no confinement anymore, the companies all of a sudden found that actually the massive demand decrease it, because actually the market already readjusted again to the capacity to go outside to the shopping malls or to buy things in different ways or service in another way, or they didn't have the need as a B2B to go to hire or subcontract or third parties companies to help them to do things. So all these readjusted again in the market. So acceleration, I think, is a wonderful second layer to consider when you're stress testing a company. Sorry, I just hijacking your conversation, but actually, I think it's
No, it's so
how you
welcome.
see things.
No, it's so welcome to see your experience because, yeah, this is really where real life example they
Yeah,
give you so much more appreciation.
Yeah, exactly.
about this. You mentioned the pandemic. Absolutely. This is where there was such a big change, and such a big change, which really tell us a lot about, first of all, to calculate your risk and to manage it,
Yeah,
but then to yeah to be aware about what growth really is, what happens when you grow the business,
yeah,
what happens when you grow a business without financial intelligence, because
yeah.
uh, when you cut margins because you just want to chase a customer, or when you behave differently. No, your observation are so precious. Yeah, absolutely. Thank you, Francisco. Yeah.
Yeah, no, you're welcome. And what is about layer number three?
Okay. Well, again, I'm creating quite a few layers here.
Yeah,
No, the last layer is about presentation versus
right,
proof. Yeah.
right.
Because let's face it, especially today with the sophistication, artificial intelligence, and so on, polished decks are really common. I mean, everyone can actually potentially do a very good polished deck to
Yeah,
investors. But really, when it comes to institutional architecture, that's very, very rare. Okay.
right.
Um, when your governance is not formal, it's just informal. Everything, for example, is founder centric, or there's no sufficient really
Yeah,
delegation of really big task, big responsibility. There's no leadership depth, in a few words.
right.
Investor will detect this immediately. So we detect informal governance, and weak board challenge immediately. So basically, they will see that. So don't try and fix everything with a good polished deck, because that will
Yeah,
not work. Yeah.
yeah,
So what I say as a final phrase is polish does not replace proof.
yeah.
So make sure that you're aware of that. So that's my layer number three, I would say. Yeah.
Yeah, fantastic. Yeah, because at the end, evidence is like I don't want to go dramatic, but actually, in any case, when you watch a movie or a documentary, at the end, the decision is made based on evidence, and in business, it's exactly the same. So you don't have the evidence of you are claiming or forecasting, probably it's not going to run long.
No, exactly. Yeah. And I was gonna say something really technical here, because
Sure,
I think
please.
we need to address it. Um, Technical, obviously, this is where financial intelligence will detect immediately what I'm talking about here. Now, growth consumes cash before it creates surplus. Okay.
Right.
So growth will need investment. Yeah. That's why it's important to have the financial discipline. Why is that? Because when revenue accelerates, usually inventory expands.
Mm,
Now, when you expand inventory, you are effectively increasing the pressure on the business, the cash
right.
flow pressure on the business, yeah, because you have to buy and you have to stock it before you can sell it, yeah.
Yeah.
The other thing that happens a lot during growth is that hiring precedes income. This is where I personally have had to apply very strong resistance in a business I was working with, where they wanted to hire before the revenue were going to come.
Right.
Yes, you have to do that sometimes. However, you need to really measure the approach, because
Yeah.
if you hire too fast before the income, growth will be your worst enemy.
Yeah.
The other thing is marketing. Marketing is prepaid.
Yeah.
You normally do not start selling before you do some marketing activity.
Right.
Marketing, I always say this is the study of supply and demand. Too many people actually they confuse it with promotion. Yeah.
Right.
So
Right.
promotion, yeah, is part of marketing, but before you do promotion, you need to study the supply, the demand, sorry. You are the
Yeah.
supplier. You need to study. You study supply and demand, but because you're the supplier, you have to study the demand. Yeah.
Yeah.
The other thing that happens during revenue is that when revenue accelerates, is that receivable will stretch.
Yeah.
So that will cause again more pressure on your cash flow. This is what I call working capital compression. and
Mm.
is the cause of so many failure. Very, I would say, very unnecessary failure. I would say that these failures are the saddest one
Yeah.
because the business is profitable and he could not keep up with market because he didn't have financial intelligence. A very sad story, but there are so many like that, is when we come out of a recession, some businesses they will start receive so many orders, but they cannot cope with it, and they fail when they should instead thrive. That's really why is it bad? Not just for me, for you, for everyone, because the economy will lose its jobs, we lose a product that we liked. So to me, that's the worst of the failure. Now, a 30% growth business may require significant short-term funding. For example, if that funding cliff is not engineered, capital sees fragility. So you're gonna go and speak to the bank. You need to really convince them. With all the filters I gave you today, you need to make sure that you're on top of this, even if EBITDA looks strong. So yeah, this is for me something technical that I thought was necessary to address. Yeah.
Yeah, sorry, I was in mute. I didn't realize. But actually, you mentioned something actually very important there that I like to highlight, which is the marketing piece, because um, people many times confuse marketing with advertising, and marketing has 7 elements. And probably everybody remembers the 7 P's of marketing, which is product, price, place, promotion, people, processes, and physical evidence. So if you're looking into only one of these P's, if you may, which is promotion or advertising, so then you're forgetting all the rest, and or is it doesn't have the enough balance to create the full marketing suite as it should be, and that also creates a big technical stress into the things. I love you highlight that thing, because actually that is a big confusion many times when they say, what is your marketing approach to grow your business? Advertising, and that's a no right away, because actually advertising doesn't mean that you have all the other pieces in place to support that. Probably advertising is the last thing you do when you have everything aligned and creating the right funnels to attract the customer based on your product, your people, etc., etc. Right. Sorry. I like how you highlight this risk that actually sometimes are not obvious for people when they are doing these approaches to looking into funding. From a risk perspective, you mentioned predictability. So time-sensitive multiples exposures, but they are unmanaged risk under acceleration where that becomes amplified, right? Because actually people, when they have this risk, actually they cannot see or they cannot control. So this amplification of risk, and say you see more risks than actually benefits. So and I think that these capitals, when we say capitals, see the funding, the investors, the banks, the institutions, that they understand that just very quickly, almost instinctively, if you may say. So if you have not model growth or the stress properly, so hesitation is logical, right? So could you show 2 examples of what looks good looks like and what bad looks like, just in practical terms?
Yeah, let me think about contrasting two cases. Yeah,
Yeah,
let's call it case A and case B. Case A is the bad
right,
one. Case B is the good one. Yeah, how do you feel about
right.
this? I'll do like this.
Yes, please.
Case A
Yeah,
is let's say you go, let's say revenue 15 million pounds. Let's say you got a strong
right.
EBITDA. Don't want to say how much, but a strong EBITDA.
Yeah,
The capital refused. Why?
right,
Well, there was some reason. First one is founder dependency. So the
right,
business was seen as too much dependent on the founder. So again, it wasn't seen as sustainable because of that. There was no formal board. There was no growth funding model, and the risk was undocumented. Now, those
right,
tests failed, and the business was refused capital effectively. Yeah.
right.
So, as I said, numbers they don't matter too much when you go when you haven't got this structure in place. Yeah. Let me go to
Right.
case B now, Francisco.
Yeah, sure.
Go to case B. Yo. Case B revenue not 15 million, but 8 million. So about half of that, you know. The C got a
Yeah.
moderate EBITDA, maybe a lower EBITDA percentage than the one with 50 million. So a much smaller business in actual fact, you know, in terms of numbers.
Right.
But the capital was secured. So why was the capital secured when you go lower revenue and lower EBITDA than
Yeah.
the other business? Well, clear reason. The first one was clear capital stack. They were managing the working capital well. They could see there was
Right.
financial intelligence into the business. There was a fractional CFO who was really answering all the question well, but it was also supporting the founder.
Yeah.
Second, there was documented risk treatment. Yeah. So
Right.
when an investor asks the question, what's going to happen if you are, say, if the interest rates are going to be higher? What happens if your inventory is going to go an extra 30 days without being sold? They were able to
Right.
answer that risk, you know.
Yeah.
The third one, there was board level governance. Even though they were a small business, they show that the governance was very rigid, very strong. Yeah. So
Right.
there was good documentation about delegation of duties as well. So very, very important. And then there was revenue visibility. The quality of revenue was very high.
Right.
There was a lot of it that was recurring. The lifetime value was many multiple of the customer acquisition cost.
Right.
So that was really the reason. Now, this was in the same sector, okay?
Right.
Same sector, despite the numbers being not as good as the first one. The different structure, different outcome. So that shows you
Right.
the proof that capital really will really follow structure, not just revenue. Uh,
Right.
yeah, so of course you need to have revenue, but it doesn't mean that you don't have a structure. So that's fundamental for many to understand, I think.
Right.
And there's something I wanted to tell you
And
about really the role of finance here. Can I tell you a few
yeah.
words here,
Yes,
Francisco?
please go. Yeah.
Well, it's really where I think lots of education is required. I would say between founders, CFO, but also investor. I would say because investor, as you said before, sometimes angel investor they don't know as much as they probably could know about what to do when to
Right.
invest. The role of finance, because obviously I'm a finance professional. Now, what's the difference between a reporter and an architect is anticipation.
Right. Yeah.
Okay.
All
Now,
right.
you can have, always say, if your finance department looks just at the past, your business has no future. I know that's a bit strong, but I really mean it. A valuation architect, which I think is what the CFO needs to be, they ask the following question: where will capital hesitate? You start to really
Mm.
anticipate what the investor will do. Now, what uncertainty must be removed before I go to an investor? I don't just want to go and speak to an investor because I need the money. I need to remove the uncertainty because I know already where the investor is going to be asking questions that is going to be uncomfortable. And now the other thing
Yeah.
is what structure must be strengthened before we approach the market, because
Right.
without a structure, the market will refuse you. So I
Yeah.
would say this fundability is engineered before fundraising begins. Don't wait until fundraising begin, because
Yeah.
when that comes, it's too late, and you're gonna be refused capital. So this is where
Yeah.
I would strongly advise finance professional and founder as well to understand this. Bookkeeper or accountants will not really help you with this. You need a CFO,
Right.
you need strong finance professional. Yeah, you might think that the cost is a problem, but the cost of not doing this properly will be much higher.
Oh yeah, no, definitely. And I think that I think the key word that you have there is when you need money, you go to the market. And I think that actually is the first mistake, because when you need money and you don't have all these structures like the five pillars and the three layers as of today, because we have another 12 weeks to go through yet. I think that that's the key problem. So if the central question will be, if capital knock tomorrow, so let's flip it around. So let's say that actually they come proactively to you. Would you pass these five filters? Would you have transferability, revenue durability, capital clarity, risk visibility, exit logics? And if not, what is the rationale? But as you mentioned, hesitation is rational in terms of capital knocking your door and say, well, you don't have these pillars, so I don't know if you're ready for this.
Yeah, you have recapped the five filters. Yeah, I would remind myself again. Number one,
Yeah.
transferability. Number
Right.
two, revenue durability. Number
Yeah.
three, capital clarity. Number four, risk visibility. And number five, exit logic. Yeah. And as you mentioned, Francisco, uh, if you don't pass these five filters, you have to expect the investor to hesitate. So
Right.
the price of not doing this is just too high. Okay. So yeah,
Yeah.
and I was gonna say this 13-week journey is just about designing structural confidence, really. There's something I
Right.
wanted to say as well to you, Francisco, and the rest of the audience here. Now, my book,
Yeah.
Fail, People Scale, launches on the 1st of March. So
Right.
from the 1st of March onwards, you'll be able to see really the link, is gonna go on Amazon. Now the book
Hmm.
is not just a motivational book, shall we say like this. It's actually very practical because there will be 26 chapter plus another six bonus one. 26
Right.
scorecard. You'll measure your business now in 2026, maybe in 2020, in 2032, whenever you want to measure your business. So you will keep it
Yeah.
because it's evergreen. And it's important to notice that I have also written this book in a very important historical moment because we got three big catalysts really, which are ahead of us. First of all, the S&P 500 valuation is 90% today dominated by intangible, dominated by American businesses that have dominated the last 3 decades, the last generation,
Right.
like Apple, Nvidia, Microsoft. We know them all, yeah. So
Yeah.
90% valuation in intangible means you have to press on what really means to be investable. Number two,
Right.
the catalyst AI-driven economy means that we have to adapt to become more investable. We need to be AI ready. Okay. Now,
Right. Right.
we can't just dismiss AI as something else that is happening to us. 40% of AI project will fail, according to Gartner. 40% of AI project. The
Yeah.
third big really pillar of everything, the catalyst, let's call it like that. It's
Hmm.
really the explosion of private capital markets. It's
Right.
unprecedented in history. It's never happened that $10 trillion in the space of 48 months will come to the market looking for businesses to be funded. And this is
Wow.
why, for me, this book is very important. It shows you how you can get yourself organized with investors to become
Right.
fundable and investable.
Very
So the book launches
important.
the 1st of March. The other thing is the high valuation cohort will begin on 8th of April.
Right.
So with this series, the high valuation code live series, we are effectively, inviting you to come to this cohort. Yeah.
Yeah.
So if you want details, comment cohort on this live LinkedIn live. One thing
Yeah.
I'd like to tell you, I mean, this is where we are not gonna be able to accept everyone because the cohort will not be a very high number of participants, maximum 25, 8 weeks starting from the 8th of April until the end of May.
Right.
So if you want to reserve your place, please write cohort. Yeah. I want to say
Right.
this valuation is not a number, it's a structural confidence, and
Yeah.
fundability is the first proof, which is why, Francisco, we're talking about fundability today. Yeah.
Yeah, fantastic. Right. So I think actually all announcements done. We have the structure, what will happen in the next 13 weeks, and the book on 1st of March, cohort 8 of April. And we have the plan already where we're going to move every week, which is fantastic because then you know exactly what is going to happen. Part of the predictability that we are claiming here. Yeah.
Well, thank you so much, Francisco. So yeah, well, we'll see each other again next Wednesday, as usual, every Wednesday, 1:30 p.m. And
Fantastic.
thank you all.
Thank you. Bye bye.